Hello, and welcome back to Principles of Accounting 1. I am still your host, Dr. B, and it is an absolute pleasure to be with all of you today. We have the majority of the class here on the call, and I sincerely appreciate that. Appreciate you taking time out of your day to join me. As always, these sessions are recorded and will be posted to the announcements page and also to the YouTube channel. So if you ever need to refer to this recording as you are completing your homework assignment, that's why I do it. Right? And it's also good to look back on it as you're studying for the midterm exam and the final exam and things like that. So make your life as easy as possible. That's why I do these things. Today we're going to be talking about how to record and analyze transactions, which is what accounting fundamentally is all about. And last week we talked about the very basics of accounting. What is accounting? Why do we do it? And really it's to record economic transactions within a business. That's what accounting is at its most fundamental level. And so that's what we talked about last week, and this week we're going to talk about those transactions. And we're going to talk about how they're structured based off of the accounting equation that you learned about last week. So before we jump into it, I want to quickly call your attention to the classroom. For those of you who are playing along, here in the classroom on the home page, if you come down to Module 1, open up Module 1, we are in Week 2. So you'll have your PowerPoint presentation there and the homework assignment that goes along with this presentation or with this chapter. So as always, as we talk about the chapter, if you have any questions, please feel free to unmute your microphone, ask your question. I'll be happy to answer it along the way. Please don't wait till the very end. Feel free to ask your questions along the way. And of course, we'll talk about all of the concepts to make it very understandable and relatable. So let's go ahead and jump into it and talk about transactions. Okay. Here we go. So last week we talked about the accounting equation. Who remembers what it is? What is the accounting equation? You can tell me.
Assets equals liabilities.
It's assets equals liabilities plus equity.
Plus equity, yeah, you got it. Absolutely. Wonderful. That's a very important formula to remember. Assets equals liabilities plus equity. Who can give me an example of an asset? Can give me an example of an asset?
Office equipment.
Office equipment, yes, as long as the business owns it and not leases it. Here's the difference with that. If the business owns the equipment and uses the equipment to help the company to generate revenue, income, then yes, it is an asset.
It becomes an expenditure. Is that correct?
If it is a lease, it's an expense, yes. That's correct.
Okay.
Yep. I'm glad that you brought that up. That's an excellent one.
Thank you.
Thank you. Any other examples? Assets.
Supplies.
Supplies. Yes, Paulette. Supplies. When you say supplies, if the supplies are recognized as either inventory or are used in the process to create a product or service we then sell to a customer, then yes, supplies is an asset. Very well done. Anything else?
Cash.
Cash is king. And yes, cash is used as an asset because we can use cash to invest into the business to help us to generate revenue, income. Well done. Yeah, so cash, inventory, accounts receivable. We didn't talk too much about this one, but accounts receivable is when a customer owes us, the company, money from a sale we had made, okay, or provided a service. If I provide a service or deliver the good to the customer, and the customer has not yet paid us, we call that accounts receivable. We have a claim to receive that cash from the customer at a future date. So accounts receivable. Cash, accounts receivable, inventory, property, plant, and equipment are all excellent examples of assets. What's a liability? Who can tell me what's a liability?
Professor, I have a question for you.
Please.
Hypothesis here. So, for example, I have a cell phone, right? And
Yeah.
of course, my carrier could be AT&T, it could be anybody, right?
Sure.
My cell phone subsequently breaks. Now, they may have services where they say, you know, you send your old equipment in, we'll give you an all new, situation if you bring it in.
Sure.
Who owns that asset? While it's in transition, is it still is the old phone still yours at that point in time until you get the new one, or is the new phone coming your way, your asset? I've always been curious about that.
I love that question, Maxine. Excellent question. It depends. And here's what I mean by that. We have two shipping methods in accounting that we track. One is called free on board, and the other one is called free on board, and there's in transit. Here's the difference. If you are shipping your asset, the phone, equipment, to the manufacturer to be replaced through a, we'll say, warranty, technically, you still own that asset even while it's in transit. It's insured while it's in transit, but still you technically own it. Ownership does not transition until you have received a new phone. Okay. So the same thing works when you make a sale. Let's say you have an online business. You sell a product to a customer. That product still belongs to the business until the customer has received it. Okay. So the same exact concept applies here. Yeah. Great question. Excellent question.
Thank you.
Yeah, my pleasure. Liabilities. We talked about assets. What about liabilities? Examples.
Accounts payable.
Accounts payable. That's when we, the business, have received a bill and have not yet paid it. That's accounts payable. Well done. Absolutely. What else?
Is it unearned revenue?
Unearned revenue. Yes. What is unearned revenue?
It's money you have not yet received. It's like, say, kind of like you pay your rent. You say you pay rent. They have a portal where you pay your rent into it, but you have the creditor hasn't received it yet. So that's unearned income for them.
For them, yeah.
They get the rent.
Yeah. I follow you. Yeah. Another example of that would be, let's say I have a lawn care business. All right. I mow people's lawns. I mow your, you pay me in advance. Okay. You pay me for the month. Let's say it's January 1. You paid me for the month of January. I have not mowed your lawn. Okay, I'm not going to mow it for a while because, it's winter. But you paid me up front. To me, the business, that's unearned revenue. Okay, it's a liability. I have to refund you if I don't mow your lawn. That's why it's a liability. It becomes earned revenue in the future when I mow your lawn, when I provide the service. So, in other words, if you collect money, payment from a customer, but you have not yet provided them with the good of the service, that's called unearned revenue. The business. Very well done. Other examples of liabilities would include
Payroll taxes.
Payroll taxes, yes, absolutely. If the business has not yet paid the payroll taxes and they collected it from their employees, that's a liability to the business. Yep, payroll. Yep, taxes. Any kind of taxes payable, payroll taxes payable, sales taxes payable. Anything with payable in it is a liability, right? Other examples would include like a short-term loan or long-term loan. We call those notes. Anytime the business owes somebody else, that's a liability. For you personally, if you own a house and you have a mortgage on that house, that mortgage is a form of liability. If you own a car and you pay a monthly car loan, that is a liability. The loan itself is a liability, right? So, yeah, wonderful. Excellent examples. Thank you. And then, of course, equity is what the owners in the business own. This would include things like paid-in capital. That's when the owners of the company invest into the business with their own money, right? It would also include things like shares of the business. We call those stock. Shares of common stock, preferred stock. I would also include things like any type of other form of ownership, right? So those are very commonly found in what we call equity. The accounting equation can be written differently. You know this? We know that the accounting equation is assets equals liabilities plus equity. It can be rewritten. It can be rewritten like this. Assets minus liabilities equals equity. Okay, that's just another way of writing it. All we did is we changed the sign in the equation. So anytime you see a question on, let's say, a homework assignment or whatever, what you can do here is just we're solving for x. We move one component to the other side of the equal sign. Right? So just some food for thought. But yes, thank you. Thank you all so much for that wonderful exercise. The reason why we talk about these things is because in this chapter, we're going to talk about how to record the transactions, the business transactions. But as we record them, I want you to remember assets, liabilities, and equity, because every single transaction is going to impact that accounting equation in one way, shape, or form. As you recall, last week we went through a couple of those exercises quickly, but I want you to keep those things in mind because those were transactions that we walked through. I showed you how they impacted the accounting equation. I want to show you how they look on paper and also the effect on the accounting equation. So that's what this chapter is all about. Thank you all so much for that. That was fun. Financial statements. Accounting, we need to express the financial condition of the business to our stakeholders. Remember that there's two types of users of information, right? There's internal users These are the people that work inside the business. And external users, these are people outside the business that are interested in knowing how the business is doing. We prepare financial statements and provide these financial statements to our stakeholders. There are 4 primary financial statements that the business prepares. The first is called the income statement. The income statement shows revenue, which is sales, minus cost of goods sold, which is commonly referred to the cost of sales, equals gross profit. And then you'll have all of your expenses listed out. Take your revenue minus cost of goods sold equals gross profit minus all of your expenses equals net income. Net income is what's at the end of the income statement, and it shows the net, right? Your sales minus all of your expenses equals net income. It's whatever is left over. If there's something left over, we call it net income. If it's negative, meaning your expenses were greater than your revenue, we call that a net loss. And that happens when the business is brand new, very commonly. So the first financial statement is called the income statement. The second financial statement is called the balance sheet. Balance sheet. The balance sheet shows the company's balances of assets, liabilities, and equity. Okay. Third financial statement is called retained earnings statement. Retained earnings are the earnings retained, kept inside the business. That's where the name comes from. And this shows us net income plus or minus any owner's withdrawals or contributions equals retained earnings. That's the money kept within the business, that stays in the business. Retained earnings. The fourth financial statement is called the Statement of Cash Flows. The Statement of Cash Flows shows the physical cash, the cash money, the paper money, coming into and out of the business. It shows us the use of cash for operating activities, which is the day-to-day operations of the business. And that would show us cash coming in from our customers from the sale, right? And cash going out of the business to pay, day-to-day bills and payroll, things like that, operating expenses. So operating activities, cash coming in from the customers and out for operating expenses. The second category on the statement of cash flows is called financing activities, which shows us the use of financing for the business. This will be taking out loans or receiving cash from the loan, which is taking out a loan. Payments made on those loans, that's cash going out, right? Stocks, bonds, etc. Cash coming in and out of the business for that use. That's financing activities. And the third category is called investing activities. Investing activities represents the cash used for the purchase or sale of property, plant, and equipment. Investing activities. Yeah. So those are the 4 financial statements: income statement, balance sheet, statement of cash flow, statement of retained earnings. Those are the 4 primary financial statements. And those are the 4 that we're going to talk about throughout the next 15 weeks of this course. What builds those financial statements? How do they get started? Transactions. Transactions represent an economic event in the business. We use transactions to record sales, to record expenses, to record pretty much everything that happens in the business. And these transactions help to build financial statements. That's what we're going to talk about today. What helps us to create a transaction? We need a document. The document helps us to create the transaction. And there's a couple of examples of a document. One example of a document is called a bill. Get that from our supplier or a vendor or from the electric company, right? So a bill, a sales receipt, a check, a purchase order, a payroll record, a bank statement, all of these are examples of source documents. And they tell us the transactions are. We need to enter them into our accounting system. The modern day, we have accounting computers help us, right, to track all of these things. We might use Excel. I personally use QuickBooks for my business. QuickBooks is a small accounting software. There's other ones out there. There's Sage 50. There's M3, Oracle. There's a lot of different softwares out there to help business owners or managers manage their accounting, right? And we use these source documents to help us to enter those transactions.
Professor, I have one question about that.
Please.
Because I see a lot of different. I didn't really get into the field yet, but I do kind of, look at stuff on Indeed, just trying to see what software, or I know Microsoft Excel is one of them. I would need to, if you come with a certificate, that's a good thing. What is the main one that most companies use, or it varies? Because it seems like a lot of people use a lot of different ones.
It depends on the company size, typically. Okay. Excellent question. So the majority of small to medium-sized businesses in the United States use QuickBooks.
QuickBooks, okay.
Yeah, I would say it accounts for about 80% of businesses in the United States, which are here in the United States. The majority of businesses are small to medium size.
So that's a good certificate to bring.
Yes.
When you're like just starting out. Okay.
Yeah, absolutely. I like that one. Definitely Excel. Excel is universal because the thing is, a lot of companies use Excel for other reasons. But if you can demonstrate, hey, I know Excel really well, that definitely adds value.
Okay, thank you.
But those are the 2 I'll go after for sure. Good question. Oh, and for those of you who are interested in all this stuff, I can create a small thing in the classroom to help you to find the certificates, how to go through that process. I'll build a small module to help you with your interest in that.
That would be so helpful. Thank you, Professor.
Hey, my pleasure. Absolutely. So let's talk about the transactions. The transactions, again, represent an exchange. Yeah, we call this an economic exchange. If you think about it this way, a transaction represents exchange. Yeah. So with every transaction, there are two accounts that are affected. An account represents an asset, a liability, an equity, revenue, which is sales, or an expense. So there's two accounts in every single transaction. We're going to roll through a lot of examples. Don't worry. And these accounts within the transaction get recorded on what we call a general ledger. Think of a general ledger like a really big spreadsheet. Okay, it's got a lot of blank lines on it, and we fill them in with the account name and the amount. And there's, like earlier I had said, that there's two accounts for every single transaction. Here's an example. I sold you lawn service. I mowed your lawn. Okay? And you paid me. That's the transaction, right? Very easy. I debit cash to increase my cash. I receive cash from you, okay? The customer. I debit cash to increase my cash. I'm increasing an asset, so I debit it. I credit sales, revenue, to increase the revenue account. I want you to think about the accounting equation. Assets equals liabilities plus equity. To increase an asset, we debit the asset. I'll say that again. Very important that you understand this. To increase an asset, we debit the asset. To decrease an asset, we credit the asset. That's on the left side of the accounting equation. Assets equals liabilities plus equity. Assets are on the left side of the equation. Now let's move to the right side of the equation. To increase liability, credit the liability. Remember, we moved to the other side of the accounting equation. To increase a liability, credit the liability. Debit the liability to decrease it. See? It's kind of like flipped.
Specific example on that, what you're saying?
Sure.
Give a specific example where that.
Absolutely.
Yeah. Okay.
Remember, every transaction requires two different accounts, right? So here's an example. I received my electric bill for the month of December, $200. Okay? Received my electric bill, $200. Obviously, that's an expense to the business. So I'm going to debit my expense account, which is an equity account. I'm going to debit my expense account, which is an equity account, to increase the expense. I'm going to credit accounts payable, which is a liability account. So my liability went up and my equity went up, or technically down. My equation is still in balance. That's the first part of the transaction. So my liability went up, my equity went down. Second transaction is, now that a few weeks have passed, I'm going to pay that electric bill. So I'm going to debit accounts payable to reduce accounts payable. And I'm going to credit cash to reduce my cash. You see, with assets, to increase the asset, we debit. To decrease it, we credit. Liabilities, if I debit the liability, I'm reducing the liability. So once it crosses that equal sign on the accounting equation, it's the opposite of assets. Make sense?
I'm still working. I know how when I'm actually doing it, I know it, like, because I've worked with budgets a lot. But just hearing it in theory is why I'm asking you the question. So
Sure.
I'll catch up to it. I'm the type of person that information has to be repeated.
It's quite all right.
Kind of got you a little bit. I think I understand it, but yeah. Okay. Thank you.
We'll go through the examples here in the next few slides, but I just want you to all kind of get comfortable with the idea that accounting is a practice. Okay? Just like a lawyer practices law, it's like a hairstylist practices hair, just like a lawn service practices mowing lawns. Accounting is also a practice. Okay? To become really good at accounting, you got to do a lot of practice. Okay? That's why it's so important to go through exercises and to really hone in on those skills. Yeah, it takes a lot of hours. I know. It takes a long time to learn anything. It takes a real long time to get good at it. But I just wanted you to understand, accounting is a practice. So the more that you practice these types of things like journal entries to record transactions, you'll get really good at it. Promise you. So let's take a look a little bit closer. Yeah. The accounting equation and the effect on the different accounts. We talked about this already at the beginning of the class. I asked you these questions. I said, what is an asset? And you told me cash, accounts receivable, notes receivable, inventory, prepaid accounts, supplies, land, equipment, buildings, land, patents, etc. What things that the company owns are called assets. Liabilities are the things that the company owes. Accounts payable, short-term notes payable, unearned revenue, accrued liabilities, those are all the other payables, and long-term notes payable. And then we have the equity account. Those are the things that the owners own. Within equity, we got paid in capital. Those are contributions from the owners. Owners' withdrawals. Those are the owners taking money out of the business. And then revenue and expenses, which equal net income. So those are all equity. Okay? With the owner's owner, the company owns. Oh, yeah, that's one way of thinking about it. So this is the accounting equation, and these are the individual accounts within each category. Which you all accurately highlighted when we first started this conversation. Assets, things that the company owns, cash, accounts receivable, et cetera, et cetera, et cetera. Property, plant, and equipment. You'll hear me keep referring to this property, plant, and equipment. Property is the land. Plant, that's the building, and equipment. We call these fixed assets. Fixed assets. Property, plant, and equipment. The reason why they're fixed is because you can't just, remove them. They're there permanently to help the business to generate revenue. Liability accounts. Things that the business owes to someone else. Accounts payable, notes payable, unearned revenue, accrued liabilities. Those are like things like taxes payable, payroll payable, etc. And the equity. Owner's contributions, known as owner's capital, minus owner's withdrawals. Anytime the owner takes money out of the business. plus your revenue, sales, minus expenses, draw equity accounts. And looking at the accounting equation a little bit deeper, assets equals liabilities plus equity, and looking at all those accounts, right? See, under current assets, you hear the word current in accounting, I want you to think 12 months or less. Current means 12 months or less. You got cash, accounts receivable, notes receivable, inventory, prepaid accounts, and supplies, also known as inventory. Well, supplies can be separate from inventory. It depends how the business categorizes it. All things that help the business to generate revenue, sales. The reason why they're current is because we expect to use these assets within 12 months or less. That's where the word current comes from. Then we see under long-term investments, sometimes the business might buy additional land or additional things that with future plans to build on. That's why I call it investment. And then this word called plant assets, another category. Plant assets is also called fixed assets. It's your property, plant, and equipment. And you have intangible assets. The word intangible means you cannot physically touch it. I cannot touch a copyright. I cannot touch music. I mean, they're kind of cool, but you can't touch music. You can't touch a copyright. You can't touch, well, technically you could touch a patent, but it's intellectual property. Yep. They're called intangible assets. Breaking the categories down even further, under liabilities, we have current liabilities, long-term liabilities. Current liabilities are what we expect to pay within 12 months or less. Current liabilities we expect to pay in 12 months or less. And long-term liabilities greater than 12 months. That would be things like a mortgage or a car loan, a student loan, notes payable. Then take a look under equities. Breaking it down even further, you got your owner's capital, minus owner's withdrawals, plus your revenue, sales, minus your expenses, equals what's left in equity, balance. As we explore the accounts, we often use what's called a chart of accounts. The chart of accounts shows us basically a list of all the accounts the business uses. And you see that the chart of accounts is organized just like it is on the accounting equation. Assets and then liabilities and then equity. And then within those three categories, you have a breakdown of each account name. You'll notice a small 3-digit number next to the account name. That number signifies its position in the list of the chart of accounts. You'll notice all the assets start with a 1. All the liabilities start with a 2. All the equity start with a 3. Then a 4 and a 5 and a 6, so forth and so on. That's why those numbers exist. It signifies its category within the chart of accounts. So when you hear the name chart of accounts, think a list of all the accounts used for the business, and they're categorized using a number. And we use a ledger when we create the transactions using two accounts from the chart of accounts. Here we go. This is where we get into the debits and credits. The fun stuff. I briefly talked about this earlier when we talked about assets, liabilities, and equity, and the concept of debiting and crediting them. This stems from what we call a T account. Don't get too excited. It's not that interesting. The T account shows us visually. That's why you see the picture below. You see how it shows like a T, right? The name's on top. And then on the left side of the letter T, we see debit. On the right side, we see credit. It always looks that way. Debits are always on the left. Credits are always on the right. Okay. If you ever look at your bank statement, okay, you'll notice debits and credits on your bank account. I don't know if they still show it that way, but they used to back in the day before, when we used to physically write checks. I don't know if any of you have ever written a check. It's these days everything's done online, but if you've ever written a check, you have what's called a check register, and you jot down debit and credit. Yeah, that's cool. But anyway, I'm sorry, I digress. See this account. At the top, we have the name of the account and debit or credit. Assets, for example, and an asset account name like cash. To increase, we debit. To decrease, we credit. And then it's the opposite for liabilities and equity accounts, and we're going to show you that here right now. I love this slide. It makes it so easy. Assets equals liabilities plus equity. And this is what I was talking about earlier. Increase an asset, we debit it. To decrease an asset, we credit it. Liabilities. Increase a liability, we credit. To decrease it, we debit. And then same with equity. But you see how the signs changed when we got to the other side of the equal sign. That's what I was talking about earlier. But this slide right here, slide 17, summarizes it nice and easy. We can expand it further. So we know equity sometimes gets a little confusing because there's a lot of moving parts. You got owner's contributions minus owner's withdrawals plus revenue minus expenses. But you can see, along with the change in sign, debits and credits for each category, for each component in equity. This slide here helps to really summarize the normal balances. Assets normally hold a debit balance. Liabilities normally hold a credit balance. Equity normally holds a credit balance. But within equity, we see a lot of moving parts. Yeah? Here is an example of a T account. This is an asset account, cash. Cash normally holds a debit balance. When we receive cash, we increase our cash. On the left side of this example, you can see all the cash we received from our customer. We debit cash every time we receive cash from our customers. So again, to increase an asset account, we debit it. To decrease it, we credit it. On the right side of this T account, you can see all of the payments we have made using cash. Sense? All right. Now, for the fun part, let me show you a couple transactions. So, first thing you do, identify your source document. Second thing we do is figure out where it falls on the accounting equation. Then the third step, we record the transaction. Then the last step, we actually post it to our general journal. That's just a fancy way of saying, here's where it belongs. So, we're going to hone in on step 3 here in a second. Here we go. This is your step. This is how we journalize it. This is how we make the entry. First, we identify the date. When did this transaction happen? Super important. Next, we figure out the 2 accounts that have been affected. That's part B. Then, how much? Part C. And then part D is just a note. What was it for? Here's the transaction. On December 1, 2019, the business began. It started. It's a brand new business. How do we start a brand new business? The owner injects cash into the business. So we debit cash to increase our cash. That's this first part here. And then we credit paid-in capital. Owner's name is Taylor. So Taylor brought cash into the business. To represent what the owner brought into the business, we provide them with what's called capital. Okay? It represents their shares of ownership in the business as well. So in this case, the owner brought in $30,000 into the business. So we debit cash, $30,000, and we credit paid-in capital, $30,000. Very next day, the company bought some supplies using cash. We debit supplies, $2,500. We credit cash, $2,500. We increased supplies and we decreased our cash. Now, yes, supplies and cash are both asset accounts. But remember, the accounting equation is still in balance. Assets went up by $2,500 and down by $2,500. But the accounts help us to understand these transactions from a visual perspective. Here is what happened with our cash for the first part of December. December 1, the owner brought $30,000 in cash into the business. December 2, we bought some supplies for $2,500. December 3, we paid something, $26,000 for something. I don't know. I think it's equipment. December 10th, we received cash from our customer, $4,200. But this kind of gives you a visual representation of what's going on with our cash. Going up, it's going down, using the T account. Yep. And on the right-hand side, you see the balance. Started with $30,000, paid out $2,500, paid out $26,000. Balance went down to $1,500. And then we received cash from our customer at $4,200, so the balance went up to $5,700. Think of it like a running total. Yeah.
So the debits is what's coming in and the credits is what's going out?
For assets, yes.
For assets.
For asset accounts, like cash, yeah. It's the opposite for liabilities and for equity. Good question. When we post the transactions, this shows you the effect Okay, so the first transaction, cash came into the business from our owner. So we debit cash and we credit paid in capital. For example, $30,000. You can see the effect on both the cash account and the paid in capital account. Because cash is an asset, we debit the cash to increase it. Because capital is an equity account, to increase the equity account, we credit it.
So when you're saying we debit the cash asset to increase it, you mean because they took that $2,500 to buy equipment or whatever, or
Well, the $26,000 from the earlier example, yeah. So
so that's debiting the asset to increase it.
we debit the asset to increase it, and we credit it to decrease it. Yep.
Okay.
All about that practice. We'll get there.
Okay.
So earlier we talked about the financial statements, income statement, balance sheet, statement of cash flows, statement of owner's equity. I'm sorry, retained earnings. I want to show you what happens to those financial statements based off of these transactions. So for every transaction, as you know, there's two accounts. One account gets debited, the other one gets credited. That's for every single transaction. We follow the 4 steps to create the transactions. Source documents come first, then we figure out the impact on the accounting equation, we record the transaction using the debit and credit, and then we post it to our T accounts, our general ledger. We saw it with that first example. The owner brought $30,000 into the business to create the business on December 1, 2019. So we've identified what it was, step 1. Step 2, we identify the impact on the accounting equation. Cash went up by $30,000 and equity went up by $30,000. Accounting equation is always in balance. Assets always equals liabilities plus equity. It's like we talked about last week, right? Third step is to record the transaction. We debit cash to increase the cash. We credit capital to increase the capital. And the fourth step, we see how it posts to the general ledger or to the T accounts. Here's the example of the second transaction. We bought supplies for $2,500. Supplies, as you know, is also an asset account because we use supplies to help us to generate revenue, right? It's a current asset. So we've identified what we did. We bought supplies for $2,500. The second step is we analyze the transaction based off of the accounting equation. Cash went down, but supplies went up. Yes, they're both assets, but we see the accounting equation still balances out. It's like a net change, right, on the assets. Step 3, we record the transaction. I debit supplies to increase my supplies because supplies is an asset account. I credit my cash to decrease my cash because cash is also an asset account. To increase an asset, we debit it. To decrease an asset, we credit it. And then the fourth step is to post it to the general ledger, as we can see there on the right. Third example, equipment. Company needed to buy some equipment, so we use cash to pay for it. See the impact on the accounting equation. Cash went down, equipment went up. Yes, equipment is an asset. It is a fixed asset. The third step is to record the transaction. We debit equipment, $26,000. Remember, to increase an asset account, we debit it. Decrease, we credit. Debit equipment, $26,000 to increase the equipment. Credit cash, $26,000 to decrease the cash. Then we post the transaction to our general ledger. Transaction 4. This one's a little different, yeah? We bought $7,100 worth of supplies on credit. On credit. Any time in accounting you hear the words on credit or on account, on credit or on account, automatically think accounts payable or receivable. Okay? On credit or on account.
I think it's accounts payable because eventually you do owe that.
Correct.
Yeah. Okay.
Absolutely right. Yeah. So it's like saying I went to Macy's. Okay, I like Macy's. I went to Macy's and I used my Macy's store card to purchase some stuff at Macy's. I still owe Macy's money. All I did is I bought it on credit. I need to pay them eventually. So for me, it created an accounts payable. I got to pay them still. Same thing. It works the same way. So, okay. So in this example, our company bought $7,100 of supplies on credit from our supplier. So we look at the transaction. We analyze it. We say we increased assets and we increased liabilities. Because remember, I bought it on credit. I still have to pay them. So I debit supplies, the asset account, to increase the supplies. And I credit accounts payable to increase the liability account. You see? Look at this second step. I increased assets and I increased liabilities. The accounting equation is still in balance. I increased supplies by debiting supplies. I increased the liability by increasing accounts payable through a credit. And I post it to my ledger accounts. Here's a fifth example. We provided services to our customer. Our customer paid us right away. Yay, that's nice. It's good to get paid right away. So I'm collecting cash from my customer right away. That's nice. Yeah, it's good. And I'm going to need to increase my sales revenue to show that I made a sale. Yeah, to show that you made a sale, you have to record the transaction. So I increase my assets which is my cash, and I increase equity, which is my revenue. Remember, within equity, we got owner's contributions minus owner's withdrawals plus revenue minus expenses. All of those equal equity. Yep. Step 3, we debit the cash to increase our cash. We credit revenue to increase our revenue. And we post it to the ledgers. Transaction 6. I'm sorry, this is blurry. Either that or my eyes just went on me, but I think this is blurry. I apologize for that. I don't know what caused this to happen, but I'll read it through you. We made a payment of an expense using cash of $1,000. We paid our rent. We paid rent. Okay? So, to pay the rent, we decrease our cash asset and we increase our expense equity. For the transaction, we debit rent expense to increase our expenses. Okay, this shows that we've paid an expense. We increased the expense to show we paid it. Remember, expenses are a part of equity. And we credit cash to reduce our cash. Then we post those to the general ledger. For example, another blurry picture. Why is it happening? This transaction shows us that we paid an expense using cash. We're paying our employees. It's important to do that. So we paid our employees $700 in cash for their salary. We reduce our cash by $700 and we increase our salaries expense by $700. So we debit salaries expense to increase the expense and we credit cash to reduce our cash. And then we post it to the general ledgers. Transaction 8. A couple of things going on here. We provided consulting services to a customer. And we also did some other stuff. Oh, we rented some equipment. Oh, that's cool. To another customer. Cool. Then we billed the customer, meaning they didn't pay us yet. We sent them a bill for our services. So here's how it looks. We provided consulting services to the customer $1,600. And we also allowed them to rent some stuff from us for $300. Think of it like an AV, you know. Oh, here's, or maybe they're renting the space. Yep. So we bill them $1,900. $1,600 plus $300 is $1,900, of course. So we increase our accounts receivable. We haven't collected the cash from our customer yet. We just sent them a bill. Yep. So we increase accounts receivable, $1,900. We expect to collect from them later. We increase our revenue, consulting revenue, $1,600. And then we also increase our rental revenue, $300. Notice how there's two different revenue accounts? One is for consulting, one is for rental. For business, in any business, if the business provides more than one type of service, you must record those revenue streams. Okay? For example, in this business, we provide consulting services and we also provide space and other things for rent. And so those are two different revenue streams for this business. It's important to keep those separated. And the reason for that is because business needs to know where the majority of the sales comes from. Yep. Very important information. So for this transaction, we debit accounts receivable, $1,900. Okay, yep. Customer owes us $1,900 because we provided them with consulting and rental services. And you'll notice two credit items. This is totally fine. Because you notice that the debit total and the credit total, they equal. They're in balance. Yeah. So debit accounts receivable, $1,900. We credit consulting revenue, $1,600 to increase consulting revenue. But then we also credit rental revenue, $300. We posted them to their general ledgers. The point here is that it's okay to have more than one account, more than two accounts in a transaction, as long as the debits and credits equal. Yeah. Here's another example of a transaction. Later on, our customer paid us. Okay, a month went by, customer paid us the $1,900 that they owed us from earlier. So we increase our cash and we decrease the account receivable. Here's what you need to know about accounts receivable and accounts payable. We call these contra flow accounts. Accounts receivable and accounts payable are what we call contra flow accounts. They go up and they go down based on their activity. Contra flow. Yeah, they go up and down. Remember transaction 8? I made the sale to my customer on account. They're going to pay me later. That increased the account receivable. Now here we are in transaction 9. The customer's paying us. So we take the cash from them and we decrease their accounts receivable because they no longer owe us the $1,900. They just paid us. Yep. That's what this transaction does. So we debit cash, $1,900. We receive the cash. And we credit the account receivable to decrease their account receivable.
So, Professor,
Please.
when you indicate that it's debit, I see it. So the debit is really, you're recording it so that this is an expectation of revenue to come. So it's debited first. And
Correct.
the reason you do that is because once the customer pays, it helps to show the balance of the account that $1,900 was an expectation.
Yeah.
Now I receive the $1,900. It's like saying this is what accounts for that. So you're not just saying, oh, where did $1,900 come from? Because you put it in the debits first to say, hey, this is money or revenue or income assets that's due me.
You got it.
Right. You can keep an account balance. You hope the customer pays.
Correct. Thank you. Thank you. Yes, you're 100% correct.
Thank you. Okay.
And the other thing we do is we do this for all of our accounts receivable and all of our accounts payable. So that way, you, the business owner, you know who still owes you money. Okay, you know what their balances are within accounts receivable. So within accounts receivable, you have what's called subsidiary accounts. Those subsidiary accounts represents all of your individual customers that owe you money. Collectively, all of those customers total equals the total amount of accounts receivable for the business. Do the same thing when we owe payments, bills, and accounts payable. Oh, there's the electric bill. Oh, I got to pay my employees. Oh, I got to pay this vendor. Oh, I got to pay, etc. Okay? All of those different bills that I received represent different accounts payables. Those are what we call subsidiary accounts. Collectively, they equal accounts payable, the total amount. You see, within certain accounts, we have subsidiary accounts. Accounts receivable, accounts payable have subsidiary accounts. Excellent observation. For example, partial payment. Partial payment. I love those. Well, this particular customer of ours, Caltech, they have a really big accounts payable, but they're not going to pay the whole thing at once. They might pay us on installment, or they might pay us based off of all of their individual invoices that we sent them, or individual bills that we sent them. So here we have a customer. We're making a partial payment. My apologies. It works the same way. It works both ways. Customers might pay you partially. Let's say that their grand total is $10,000, but you sent them multiple bills for multiple transactions, multiple invoices. You see? They're not going to pay you the whole $10,000 right away. They're going to pay you invoice by invoice, different checks. Yeah. The same way works for us. I might have a huge bill with one of my vendors, I'm not going to pay them the whole thing right away. I'm going to pay them invoice by invoice because they're a long-term vendor. I got a lot of different transactions with them. So I'm going to pay them, a little bit at a time. Call it partial payment. So here's the example. We're going to pay our vendor $900 in cash toward our accounts payable with them. This stems from transaction 4, for those of you keeping track. Second step is analyze the transaction. We're reducing our cash and we're reducing our accounts payable. Reduce an accounts payable, which is a liability account. We debit accounts payable to reduce our accounts payable for that vendor. Okay. Debit accounts payable, $900. Credit cash, $900 to reduce the cash. Oh, thank goodness it got more clear. I can see this one more clearly. Another example. The owner's taking out some cash for personal use. Maybe he's taking out a potential customer out for dinner or something like that. So, owner's withdrawal. Taking out $200 for cash. We reduce cash by $200. And we increase owner's withdrawals by $200. Equity. So we debit owner's withdrawals, $200. We credit cash, $200. I'll post it to our general ledger. I got blurry again. I should see my eye doctor. Transaction 12. We receive some cash for future services. There's that word, future services. We have not yet provided the service. And you all know what that means. Unearned revenue. It doesn't become earned until we provide the good or the service. So in this case, we increase our cash and we also increase our unearned revenue liability. So we debit cash to increase the cash that we receive from the customer. And we credit unearned revenue, $3,000. Remember, it's unearned. We have not yet provided the good or the service. Therefore, it is a liability. Now, in the future, when we provide the good or the service, then at that point, we'll debit unearned revenue and we'll credit revenue to make the adjusting entry. Talk more about those soon. Another example. One of my favorites. We're going to pay cash for the future insurance coverage. People like me, I pay my insurance for the whole year in advance. Okay? Because I get a discount. Otherwise, I wouldn't do it. You get a discount. Pay a whole year in advance. That's cool. We call that prepaying. Anytime that you prepay something, meaning you're paying for it in advance of it actually happening, we call it prepaid. Anything prepaid is an asset to you, an asset to the company. The reason why it's an asset is because I could always cancel that insurance premium and they're going to refund me. See? And also, I have not yet used the insurance. I paid in advance. Therefore, it's an asset to the company. So step 1, we paid $2,400 in cash for a 2-year policy that begins December 1. We decrease our cash and we increase our prepaid insurance, which is an asset. We debit prepaid insurance to increase the asset, and we credit cash to decrease cash asset. And then we post it to the ledger accounts. Number 14. We're purchasing some supplies for cash. Supplies is an asset. $120 worth. Decrease our cash, increase our supplies. We debit supplies, we credit cash, and we post to our ledgers. Another example, 15. We're going to pay an expense in cash, our electric bill. With the electric bill here, we're just going to pay it right away. Don't even play with accounts payable. We're just going to pay it right away. Okay, cool. There's nothing wrong with that. I'm going to reduce my cash and increase my expense equity. So I debit electric or utilities expense, and I credit cash, and I post to my ledgers. Transaction 16. I'm going to pay another expense in cash. I'm going to pay my employee. That's a good idea. Pay your employees. Okay. I'm going to pay my employee $700. So I reduce $700 in cash and I increase my salaries expenses, which is an equity account. So I debit salaries expense and I credit cash and I post to my ledgers. Yeah, after a while, you get used to it, right? Earlier, I had mentioned that accounting is a practice. The more you practice these journal entries, I promise you get really good at it. So take a look here. This is our general ledger, and you can see all of the transactions that we just did. So we just went through 16 different transactions. In this image, you see within the brackets the transaction number, yeah? And where they affected, the accounts that they affected. It's kind of cool, right? And you see that assets equals liabilities plus equity up there at the top. And you'll notice if you go through the balances and you total them up, like $42.75 in cash, 0, $97.20, $2,400. I add all those up. And then I add up my total liabilities and my total equity. You'll notice that those amounts, they equal, they balance. And so, yeah, it's kind of nifty. but this kind of shows you the summary of those transactions and the impact on the general ledger. So, oftentimes what we do in accounting is we need to make sure that we're right. Okay, it's easy to make an error. And so what we do is we prepare what's called a trial balance. We list out all of our accounts on the chart of accounts. Okay, list them all out in order. And we provide the balance of all of those accounts. And we list it out. And we verify that the debit column equals the credit column. What this does is it proves that the balances are correct. Yeah, we call that a trial balance. We're trying to get it to balance. Trial balance. This is an example of the trial balance. You see, we listed out all of our accounts and then the account balance, whether it's a debit balance or a credit balance. And you see the debit column equals the credit column. That's how you know that your transactions are correct. Look at checks and balances. So we make errors. It happens. No one's perfect. Okay? We all make errors at some point. And so in accounting, we look for errors. Because we got to make sure we're accurate as much as possible. So we make sure our trial balance works out. We look at, make sure that the general ledgers are correct. We make sure our debits and credits equal. And we go through these steps to kind of verify things, make sure it works. And at the very beginning, I mentioned that we use these transactions to help to create our financial statements. Income statement, balance sheets, statement of owner's equity, statement of cash flows. Transactions help to create all of these things, yeah. And those statements that we talked about developed through those transactions. So the income statement shows all of your sales minus all of your expenses equals net income. Statement of owner's equity shows us changes in the ownership through withdrawals and contributions and net income. The balance sheet shows the balances of your assets, liabilities, and equity at any point in time. And the statement of cash flow shows the cash coming into and out of the business for operating activities, investing activities, and financing activities. Here is an example of the income statement. At the top, you always have your revenue. At the bottom, you always have your expenses. You notice how everything's listed out. Revenue minus cost of goods sold equals gross profit minus your expenses equals net income. For your owner's equity, investments minus withdrawals plus net income equals ending equity. On the balance sheet, you have your assets, liabilities, and equity. All of your balances are listed out for each account. Sometimes when we make journal transactions, sometimes we make an error. It's okay. It happens. It's important to understand what those are. Sometimes it's a matter of a comma, a decimal point, But I tell you, sometimes those errors can be really big. Like, what happens if you accidentally put too many zeros? It's like, oh man, your sales were amazing. Well, you know what I mean. It's important to really be careful, especially in accounting, and with a lot of money. Now, let's talk quickly about a couple of ratios. In accounting, in finance, in business, we look at ratios to just very quickly give you an idea of how well the business is doing. And one of these is called the debt ratio. The debt ratio helps the business to identify its level of risk. Okay? Banks commonly use the debt ratio before giving you a loan. They take your total liabilities divided by your total assets to get your debt ratio. Tells me what the risk is of you being able to pay it back in the future. Banks use this on all of us all the time before making a decision to give you a loan or not. It's a good one to know, right? And you can look at, for a business, take the total liabilities divided by total assets, and you can look at it from year to year and identify trends and changes. Okay, my friends, we made it to the end of Chapter 2. Yay, wonderful. As a reminder, in the classroom, Module 1, Week 2, you'll have your your Chapter 2 homework. The homework assignment is about 5 questions, a mix of true, false, and multiple choice. You have 2 attempts on every single homework assignment and every single quiz in this class. What that means is the higher of the 2 attempts on the homework or quiz will be accepted into the gradebook. Okay? Remember, accounting is a practice, so I want to try to give you as much practice as possible, especially on homework assignments and quizzes and all those fun things. So I want you to do well in this class. Your well-being is important to me. Are there any comments, questions, or concerns? Doing all right? Okay.
No, I have a question.
Go for it.
When you were going over the assets and liability, like if you debit the asset and you credit the liability, that means you're crediting another asset, right?
You're on the right track. So if I debit an asset, I'm increasing the asset. If I credit a liability, I'm increasing the liability.
Mm-hmm.
Okay.
So that goes back to the beginning.
Yeah, exactly. So if we take a look at and this is probably like one of the most important slides ever, right here, slide number 17. What this shows us is how the accounting equation maintains its balance as we're affecting assets, liabilities, and equity accounts.
Right. So if the asset is debited, the liability is credited.
Yeah, if we're like receiving cash from a loan or something like that. Yeah.
Mm-hmm.
It's just a matter of going through those exercises. I promise once you do that, you'll know this stuff perfectly.
Okay.
Excellent. Okay, my friends, well, I sincerely appreciate your time today. Appreciate all of you and your hard work. Please try to complete the Chapter 2 homework assignment by this Sunday night. I recommend that you use the class time on Thursday to do that. That's why I provide the class time for you. If you need anything, you can always email me, call me, set up office hours, whatever you need. I'm here for you 100% of the time. I want to say thank you so much for your time. I appreciate all of you. And if you ever need anything, I'm here for you. Thank you all so much. Appreciate you. Have a wonderful rest of your night.
Thank you, Professor.
Thank you.
Thank you.
That's
Thank you. Take care. Bye-bye.